Okay, welcome to auction market theory and its basics, and how to read the market as an auction market theorist. We may do some order flow, but I have a itinerary right here that you can hear as paper that I will go over first, and then we may delve deeper into that either now or in later videos. We'll see. So let's start with the introduction. What exactly is auction market theory? What are these distributions that you see when I when I send these screenshots into my channel, right? Well, let's look at it. A normal chart looks exactly like this, minus these green signs. This is just delta. Ignore this green and red here. A normal chart looks exactly like this, right? You'll see price progress across the y-axis, across the horizontal axis. I want to make sure I don't get this wrong, because last time I did. And instead, TPO allows you to take that and puts it on the vertical axis. Give it 1 second to load. There we go. So it shows you all of the time that the market has traded within. You see here at the top, I have within a month. Each of these sessions would be a month, would be a day. Each session would be 6 hours, which is a week total. This is 30 minutes, which equals a day. And this is 30 minutes, which equals a session, like the London session, the Asian session, etc. So you may ask, why exactly is this valuable? And this is because you can find pockets of liquidity, and where liquidity is, or rather where liquidity is or not, is where volatility is. And we as traders we bathe in volatility, you know? We are momentum traders. Let's move on. Let's give an example of a single print. Here's one that happened today exactly. You see these two lines right here that say a single print of 14 and then a single print of 4. What it's referring to is it took 14 ticks, which is equal to about 5 cents of non-stop down movement before it was interrupted by the next candle. This indicates extreme volatility and a lack of liquidity in the market. Normally, what I like to do, at least on the next day, but more often than not, the market does tend to correct these single prints on the exact same day. So I look for confluence and order flow, which we will get into later, which will help you find these signs. Now, let me go more into depth into what auction market theory is itself. Auction market theory is essentially the idea that the market is constantly seeking balance, and that balance is liquidity. Let's look for some examples here, shall we? So as you see, the market is clearly unbalanced. Look how wide these distributions are. This is what a normal distribution here looks like. This is what a normal consolidatory day looks like as a whole. But as you can see, when there's a lot of volatility and a lack of liquidity, the market can be the distribution can be extremely anomalous, and these inefficiencies end up getting repaired eventually, and these can prevent trade options later on into the future. But right now we are looking for balanced point of reference. And then here we are, we found one. This is a composite I made earlier in a video that I was going to release, but I had to remake it. Note how the market came down from the top here off of its initial balance high and its initial balance low. I'll explain those in a second. But to sum it up, those are the first two 30-minute periods of the trading day, and those are the most pivotal moments of the entire day because they set the stage more often than not for how the market behaves. So if the market, for example, were to break down just like it did here and then retest the initial balance high and fail, you would be confident that you would be able to short it. Now, once we got down to this area, which is known in the past for having a lot of liquidity, the market essentially remained sideways for quite some time until it got to the top of the value area high. When that happens, something called mean reversion happens, which is essentially when price is too far away from its average to sum it up in a very lackadaisical way. It's too far away from its average, and it then course corrects. But it often overcorrects. It never corrects down to the T. You will always see an overcorrection in the markets because humans and the algorithms that the humans have built are inherently irrational. So therefore, you will always see this type of funky jaggedness right here as it seeks balance again, just like it did right here. But this is a perfect example of a market in complete balance and complete liquidity until it decided that the bulls have won and it wanted to move higher, right? Another way to think of this is thinking of the market as a two-way auction bidding process, right? Like, have you seen various shows where they do bids on what is this Sotheby's, right? Where they do various bids on rare pieces of art, and they say $100,000 going 150, 150, 175. Do we have 175 bid? 180 ask, etc. And once it gets to the top and nobody else wants to buy, it sells right there. Markets are two-way. So what that means is that when people lose interest at the lows or at the highs, it tends to, quote unquote, I use this word very loosely, automatically mean reverts to where the most popular price to do business was, which is these blue lines here that you see. These are called the point of control. You have two different types of point of control. You have the volume point of control, which is where the most volume was spent, and the time point of control, which is where the most time was spent in the market. More often than not, in my personal experience, the time point of control is the most reliable, but the volume point of control can also be very handy under certain circumstances once you learn to create your own strategy. Remember, I am not a shot caller. I'm not a teacher. I'm simply an illuminator. I want you to learn these new, not really new, but somewhat esoteric ways of how to view the market so that you can then create your own trading strategies around them with zero catch. That is all I want to do. And so we will continue on. Now, let us talk about one of my favorite trading setups here. I talk about this all the time in the group. You may have noticed. Here's the perfect example right here. When the market is in a consolidatory phase, and there's often high volume, and it bunches up in an area like this, I like to call it a TPO stall. There's likely a different word for it, of which I'm just not familiar. Here goes another example right here, and another example right here. Normally what happens is that there is an immediate reversal within the next several hours to either the upside or the downside. And the reason is because those who are trying to push the price down for C period, F period, G period, K period, and Q period got less and less success over time, as you can see. We don't use trend lines, but this is just to essentially point this out, make it easier to think of. And so because of that, the shorts, or rather, it could be anybody really. It could be shorts, or it could be buyers looking to get out of their position, who are meeting a bid, and then the bid suddenly became a market buy, just as you see here with the delta, and it shot up. So you have to use discretion when you look at TPO stalls, because you can be looking at either a short squeeze, you can be looking at a just like I mentioned, or so on, etc. Right? Now, the thing that you want to remember is, since this is based on statistics, you have to remember that this is a statistical game. These distributions, if you are aware of if you have a statistical background, are known as bell curves, and they come in 3 standard deviations. The third standard deviation is 99.5%. The second standard deviation is 95%, and the first standard deviation is, if I recall correctly, 65%. So you want to keep all of this in mind, because the more out of the extreme it goes in the value area, the more likely it is to come back and mean reverts to an extreme that is larger, that is more severe than necessary. That's the issue with mean reversion for most people. They think mean reversion, they think that it will automatically go back into the sensor. Well, no, it's more like a sine wave, right? It will always be like this curly motion, so to speak. These loops, these humps that I'm making with my mouse right here. It will never be meeting the straight line, so on. It'll never just be straight. It will always oscillate between that line. And so that is where we take our advantage. Now, this strategy can be used in both volatile markets where the sine wave is extremely wide or also extremely small. I was trading this back in October when the market was trading at maybe 0.5% to 0.3% a day. I was trading like just $10 scalps, $15 scalps with insane amounts of leverage, and it still worked. It certainly still worked. I would say it probably worked worked at its best because I found new ways to think of auction market theory that still apply to this day, right? Now, let's look at the initial balance. Let's see why it's important, right? I want to get a really good example. Here's the example I used earlier. Earlier, I mentioned the open of the CME. I meant to mention the close. The close was right here. Now, normally you want to look for 100% overnight inventory, but I'll let you in on a secret. 80 to 90% overnight inventory is fine. And what I mean by that is that if it is below or above the close 80 to 90% of the time, then the next day for 2 to 4 hours, it is highly likely that that trend will continue. So we saw that the market was tried to break these stops here that I talked about in the group. It came down, right? It sought balance. It consolidated a bit. Even did some one-time framing here. One-time framing is another concept that you will learn. What that is essentially when the market does not break its lows and it only breaks its highs, it only makes constant progress. B is not a one-time frame simply because it broke A's low. But B, C, D, E, and F are. This implies lots of strength in the market. But let's move on. Let's go back to the main point. So, now that we know that our overnight inventory was mostly short, we can expect that the next day should be short as well. So we wait for the A period and the B period, which, remember, this is the 30-minute chart, so each period is 30 minutes. We wait for the A period and the B period to come in, and we see C start to drop. This is where you want to look for a short, but you never ever take a position, especially in the early parts of the day before the period closes, or you would have gotten trapped right here, as a lot of people did here. You can see in the delta bar, 0.54%, and there were some shorts here that got in. So a lot of these guys ended up trapped, and they got trapped. They became cannon fodder, as you can see. So I saw this and I realized that in the past, more often than not, during D period and E period, the market will, for some reason, whether it be algos or actual humans, they become frustrated and they start to let go of their positions. They start to drop their positions, and the trend that you expected reverses. And this opens a great opportunity for a very nice trade, which is what we did indeed do. We got to 1654. I mentioned 1660 or 1640 if I recall, 1648. I believe it was because due to my concussion that I confused that with 1706 and 1670. I'm not sure, but I'll take total responsibility for that. I'm not, trying to hide behind anything, so to speak. So that is how the initial balance works. Now you may ask, what is this yellow line here during CME? This is the halfback, and the halfback is extremely important for the next day or even the overnight session for determining the trend. Like, as you see, the market came down to B period, it bounced off the halfback, it came back, very slowly and slowly broke through. That break was all that was needed to confirm that the next day may be bad, as well as the fact that it could not break this SMNY candle here, which is something I forgot to go over. I will not leave any stone unturned here. The SMNY candle is the very candle that started this entire movement. It is the short squeeze candle. It is the candle that first broke out of its initial balance and then closed higher. This provides a very valuable price range that is almost always respected in auction market theory. Let's just look through all the different examples and we can see how it's respected. We have 1, 2, 3, 4, almost 5 here with S. There's just so many different examples. 6 right here. The market tried to come down. It couldn't. The market closed above it right here. 7, 8, 9, 10. I mean, the amount of bounces in this area are just innumerable. Here goes some more. 11, nearly 12. It comes down, respects it, barely touches it. Pokes his head out, instant rejection, comes down, tries again, instant rejection. This range is always very, very respected. We can see an example of it here. As you can see, for this day, it determined the trend for the rest of the day. Now, I think we've talked enough about these SM candles. Let's talk about how fractal markets are, because initial balances can be used on the session level. It can be used on the daily level. It's colored blue right here. You see the initial balance low, initial balance high. It can be used on the weekly. You see the halfback, etc. So let's dive more into that idea, but let's use TradingView instead. Here are the ranges I have for this week's and this quarter's initial balance. As you can see, we are quite below the initial balance of the quarter, because it says 1.5 and then 2x. The quarter started all the way up here, so we broke the lows and then continued downward. Note how effective these lines are as price targets and how trustworthy they can be. Let's go back here at the start of the week, and let's look at how the market interacts with them. You see that once it breaks the initial balance, the middle of the initial balance, it almost always comes down to the low. And once that happens, one of two things will happen. It'll either go down to the 1.5x, which is down here at 1575, or it will reject, or sometimes it'll just teeter along it. But when that happens, more often than not, it will return back to the initial balance, because that is what is considered a failed auction. A failed auction is essentially, like I said before, when I mentioned in the server, is when the market breaks the initial balance low but fails to hold it within a specified amount of time, and it then retreats back into there. At that point, there is a very high chance of mean reversion, meaning that at the very least, you would expect price to see the middle of its range for the week, or even the high. It depends. it really does depend. The probabilities are different. I used to have the probabilities on hand because I actually measured it, including like how many standard deviations of delta a candle is out from the mean, as well as volume, etc. But I don't have that data on hand with me at the moment. But you still see the point. Also, another big thing to consider is the value areas. This is the quarterly value area high and the quarter value area low, as well as the point of control, where the most volume was spent. And maybe likely where the most business was spent as well. This makes it a bit of a magnet. So once the market comes down and touches the value area low, it more often than not comes back up to the point of control. And at that point, you have to use discretion. This is where order flow comes in, because it can then either reject and continue down due to shorts or people trying to exit their underwater longs as they've been longing this entire bottom, or it can continue higher. So these are, to sum it up, these are our weekly, monthly, and quarterly initial balances that I have measured here. Yeah, it's a lot of lines, I know. Now, let's move on to something more personal. Let's look at the daily time frame, yes? This is October 1st. This indicator that I've shared in the group makes it a lot more easier to not only see the initial balance. If you use stock settings, the initial balance is actually highlighted in orange, so you don't have to just read the green, the serrated, the dotted orange, and then the red. It'll just show as a solid orange, but I prefer it this way. But anyway, just let's look at this and see if we can find any patterns. I will not point out anything to you. I want you to learn about this tool, this technique, and see if you find any patterns and how they can be exploited. I will give one trick away though. I'll give one trick away. There's one thing that normally almost always happens. When the market comes down and hits its 1.5x initial balance low, it will almost always retreat and hit either its initial balance high, its middle, or its 1.5x. That's the only thing I will spoil you guys with. The rest I want you all to learn organically. This is a very beautiful, amazing tool. Let's look at another day.